Good morning, folks, and welcome to another edition of Weekly Wrap. And we have lots of juicy items to cover this week, right from what Donald Trump is doing to the monetary policy announcements in India, and some very interesting perspectives from senior analysts like Ridham Desai. Okay, so I think I will first do a deep dive into what Ridham Desai spoke to the Mint this week. Okay, so Ridham, as you all would be knowing, is the managing director and chief equity strategist of for India, Morgan Stanley. Okay, his views are very well respected, and not only in India, globally. So let's hear what he has to say. The headline says, "We have decoupled from global capital market cycles." So whenever we hear the word decoupled, all our red flags go up, right? So people have spoken about all kinds of decoupling, and then we know that really does not happen, and it's an excuse to egg the market on. Here, I do think what Ridham is saying is meant to be paid attention to, because it simply makes economic sense. We are nowhere speaking about the markets, all right? So, of course, the first question put to him was about what do you think could be the impact of US tariffs on the Indian economy. And as we have discussed before, he also says the exposure of US to Indian exports to Indian GDP is only 2.2%. So as a GDP number, we should not be too worried about it. Okay. And then we come to another question. Okay. Profits of broader markets grew in single digits for 8 straight quarters as of March end. This slowdown does not seem to be worrying you. Why is a question to Ridham, and he points out a few pretty interesting macro indicators. Okay? He says our terms of trade have changed. India needs less oil to run its economy. So if you're looking at a kind of a ratio of output per unit oil or unit output for the oil consumed, then we find that as an economy we have become more efficient, and to produce 1 unit of output we need lesser oil now than we did earlier. Okay, and this is also one reason why our current account deficit is reducing. Now, what is a current account deficit? It is the gap between how much inflows are there by selling our goods to the rest of the world, okay, and how much the rest of the world, how much we need from the rest of the world, and how much the rest of the world takes from us. Okay, the gap between these two is the current account deficit. Essentially, India is capital deficit. It needs capital to make its economy grow. So hence we need to borrow from the rest of the world. Okay, but as our economy grows and becomes more efficient, we find that we need to borrow less and less from the rest of the world, and this shows up in the current account deficit, which was only 0.6% of GDP last year. It also means that our savings have been going up. India's savings is going up, and we need less from the rest of the world, and that means our current account deficit will be narrow. So it's a reflection of our savings rate. It also is a reflection of what we have to buy from the rest of the world relative to what we are selling to the rest of the world. So this is a very critical indicator of how our economy and currency is going to be more and more stable going forward. Okay, keep mark our economy, the macroeconomic stability, and the stability of the Indian rupee. All this gets concerned. Okay? So if we compare this with 10-20 years ago, Ridham says, when we were highly coupled to the world, highly coupled to global capital market cycles, because we had a big savings imbalance. So because we as a nation were saving less, we had to take more from the rest of the world, we had to borrow more from the rest of the world. So we were very much linked to global market cycles. Okay, and hence when global capital market cycles were down, there was less funding coming into India, which was why our stock markets would fall. It's not because of stock markets elsewhere in the world that we are falling, not because they are falling and we are falling. It's because that we had a low in the global capital market cycles, and hence funding to India was coming lesser, and hence the Indian stock markets reacted badly. So that is the real relationship that we need to be looking at as per rhythm. And I do believe this because this is standard economic sense. Okay. So whenever global capital flows shrank, which is what happened during US recessions, we got hit. If you plot the BSE Sensex correlation with US recessions, you get a very tight correlation, even though we did not have a very large global trade share. It's not that we were impacted by global trade. We were just impacted by less money coming into India. Okay. And all that because of a weaker balance sheet. Now we have a stronger balance sheet. Our profits are currently at about 5% of GDP. Our previous peak, which was hit in 2010, was 7% of GDP. So in between, we had quite a famine when profits to GDP as a ratio came down very, very low to 3% and or 3 and 4%. And now we are back to 5, and rhythm thinks we can go back to 7%. And given this kind of higher profits to GDP, the markets have a lot of room to grow from where we are. And this is what you and I should be noting, that yes, there is room for markets to grow because of a strong national balance sheet. Okay. Then we are, of course, speaking about capex. Okay. So the question to him is, but can the relative slowdown in government capex hurt earnings, especially if private capex does not fill the gap, is a question to him. And of course, this is something that we have discussed often in the past. We did have a slowdown in capex. Okay. And the recent slowdown in capex was due to an extended monsoon and an election year. And that has been overcome. So even if you're looking at this quarter's government capex, it is far higher than the same period last year. Okay, though the overall budget for capex remains the same, the spending by the government is accelerated this year, and that should be good. In fact, this had already begun to turn in the last quarter itself, in the previous quarter, and that rhythm says was reflecting in the earnings with a slight lag, which is fine. So the positive impact of government capex on earnings should only be improving as we go forward, and that bit of a dip or a gap last year, that spot is behind us as per rhythm. Okay. And the other thing to note is that we spent the private sector spent a lot on capex in the earlier cycle of 2010, and we do not need to spend so much again on building new steel plants or new cement plants, etc. So that kind of capex we don't need. And somehow we like to think that with only new factories and new steel plants and new cement plants coming up, we think that there is capex and the economy is expanding. No, we need to take a slightly different view. And even we need to be looking at where some of the capital flow is going in. It's going into different kinds of capex. Think data centers. So data centers which need a lot of capital, okay, and we don't really think of it as capex, but yes, a lot of capital is going there. Of course, as we talk about the NPC, we will talk about credit growth. Okay. So he says he's confident that we have evolved. We are not in a problematic situation as far as capex is concerned, and that is something I think we need to be happy about. Okay. This article by Niranjan Rajadhyaksha, who is the executive director at Artha India Research Advisors, really caught my eye. I don't always want to talk about, I don't like to discuss too much about crypto in public forums for the reason that they may think of it as a recommendation. Okay, I am definitely not recommending, but let's see what's happening. Okay, we all know about Bitcoin and Ethereum. There's another genre of crypto called stable coins. Okay, so stable coins are backed by currency, unlike a Bitcoin or Ethereum, which are not backed by currency, and their value is swings wildly only because of supply and demand issues. Okay, and they have no fundamental banking. There's no asset backing to it. But there is a genre of crypto, and they are called stable coins. Stable because they're backed by assets. So what the US government has been doing is they've been quietly building the legal structure to promote stable coins. Okay, and these stable coins will be backed by US dollars or US treasuries. See what's happening. Okay, on what will this do? This will definitely find appeal for those who want to transact in crypto. Transacting in Bitcoin is very difficult because of its rapidly, widely fluctuating values. But if you have a cryptocurrency which is actually backed by an asset or a promise, such as a promise by the US Fed, then it would be looked at as a good medium for transacting. And if, as the US government and if many think, there is going to be a large demand for stablecoin, it is just that the US government is in a sneaky fashion building back a demand for US dollars and US treasuries. Okay. So on one side, you have economists such as Miran, who's now nominated to the Fed board by Trump, or as a top contender to be nominated to the Fed board by Trump. He was advocating a weaker dollar to help trade. But with this happening, you're not going to get a weaker dollar. You're going to allow as much borrowing by the government as it wants because of people wanting to transact in stable coin. And on the other hand, you have somebody who's an economic advisor to the government of US saying that we should have a weaker dollar. Trump wants a dollar dominance. Economists want dollar weakening. So there's a lot of contradiction happening, and I don't think anybody in the world is sure as to what the US wants at this stage. But there is a sneaky development happening on the side with stable coins coming into the picture, and this can really queer the pitch for global central banks. How do they manage monetary policy if you have something like stable coin coming in and occupying the limelight? So these are all issues which I think we need to be very careful about, and landscapes are changing pretty fast. Okay. This week we also had the Reserve Bank of India having its monetary policy committee review, and even before the review, there were a lot of people, swinging both ways, whether that there would be a cut or there wouldn't be a cut. But I must say that more of them did not expect a cut; they were expecting a stability in interest rates. But the kind of language that the Reserve Bank of India's governor had, it does show that yes, definitely there's no cut now as he has announced, but we don't expect any cuts in the rest of the year either. Okay. So what has taken people back is the inflation projection of the RBI. Right now, inflation is under control. And for the next couple of quarters also, for this entire financial year, we don't expect inflation to be a problem. But the quarter after that, the RBI is projecting almost an inflation rate of 5%, which is way higher than where we are now. And if they think that inflation is going to be higher in the near future, you can be sure they're not going to be cutting rates till that data disproves them. Because the last thing a central bank wants to do is shift policies quickly. That creates a lot of confusion for the economy, and hence stability is a priority. You will not expect another interest rate cut till we know for sure that inflation is not going to go up next year. Okay, so that is one thing. As a result, long-term bond prices have fallen a bit, absorbing this view that there won't be an interest rate cut. We all knew, we all sort of guessed that this would be a shallow interest rate cycle, but it has turned out to be much shallower and much faster in its turnaround than any of us thought. Okay, so inflation projections is one, all right, and yes, rates did not get cut. Liquidity has been ample. Okay, almost 4 lakh crores. This is a little more than what the RBI wants, and some of this liquidity increase is because over the last few days, to defend the Indian rupee, the RBI has sold a lot of dollars. that could have easily added about 80-90,000 crores of liquidity to the system. Okay, and the Reserve Bank came back to absorb this liquidity to what we call a VRRR, a variable repo rate auction. Okay, and surprisingly, it got a very tepid response. So it wanted to borrow all this money back from the market, but the market was not willing to lend all of it back to the RBI because they saw that call money rates were little firm and they could probably make more money out of the surpluses than lending it to the Reserve Bank of India. Okay, so that is on liquidity. And another aspect that we have been speaking about in the past with relation to growth in banks was credit growth. Right? So credit growth has been rather tepid. It's been meandering around 10, 11, 12% and not really going beyond that. So if you sort of extrapolate this data and connect dots, one can easily say that credit growth not happening, private capex not happening, economic growth not happening. But that would be a wrong connection of dots. Okay, there's more dots we need to get into the picture before we come to our conclusion. So it has also been happening that large corporates have been borrowing directly from the market without going to the banks. So large companies with a very good reputation and a credit rating can very well avoid this intermediation of going through banks and directly borrow from the market at more beneficial rates. Because the market is confident, they will lend to these corporates at very reasonable and low rates than the banks. So almost about 2 lakh crores have been borrowed by companies directly from markets. So if you sort of add this to the credit growth, it's similar. I mean, we can say that credit growth is stable, it is not bad. Okay. So the what the Governor Malhotra said is that flow of non-food bank credit during FY 24-25 fell by 3.4 trillion to 18 trillion. But like what I said, the flow of credit from non-bank sources made up for the fall. Okay, so don't go by just this number, add up the total flow to the commercial sector. Okay, and given the adequate amount of liquidity, transmission of rate cuts is going to be faster this time around. All right, so this is what we have to be paying attention to. The tariffs seem to be just getting worse, right? Now Trump has announced a further tariff of 25% on India just because India, as a sovereign nation, not wanting to bend down to Trump, is doing what it thinks best in its national interest. And that definitely gets Trump's goat. And he's now, whatever he says doesn't make any economic sense, does not make any logical sense. Whatever he says, whatever it does, is pretty insane. And I don't think anybody has control about on what he's doing or what he's saying. But as a result, yes, markets are nervous. So the entire last week, we had a very weak stock market, and I do think till this gets resolved, markets are not going to be very optimistic. And like Rhythm Desai said in his interview, the second order effects are a little more worrisome. Yes, we don't have a direct exposure to to the US economy as much as some of the other countries have, and that's why they are the ones who have rushed to Trump's table and hammered out a deal, whether it is in their favor or not. But India's exposure to the US is lesser, and that is one reason why we are willing to stand for some more time and test their patience. Okay, we may not have the leverage like China has on the US, like supply of, say, rare earth minerals. Okay, we don't have that leverage, but we are far more independent in our economy than China is. Okay, so these are the reasons why I think the government will stay firm for a longer period of time, but the markets are going to be nervous in the short term. All right, and while stock markets in India have been weak, stock markets in the rest of the world have been positive because their dealing is over. They've come to a negotiation. They've finished their deals. So their stock markets are more firm. It just adds one more reason as to why investors in India should diversify globally. Economic events cannot be predicted always. Okay. So if you're looking at the time from April 2nd till date, April 2nd is when tariff announced his intention to impose tariffs. To date, all the countries that have been able to negotiate with the US and come to a conclusion or come to a trade deal, their stock markets are up. Their stock markets are way more higher than India. Okay. So please bear in mind, this is a strong reason. Today it is tariffs. Tomorrow it could be something else. We're in a very dynamic environment. We are in an interconnected and global environment, and hence we should be diversifying globally. And to make it easier, the Gift City has a number of AIFs and funds that allow Indian investors to remit to the Gift City in dollars and invest in the rest of the world. So there's an article here in the Mint says accreditation unlocks Gift City AIFs for Indian investors. So what is accreditation? An accredited investor is somebody who's more knowledgeable and whose ability to take risk is higher than the retail investor. That is what it means, not only in India, but globally. So unless an investor meets a certain net worth criteria or an income criteria, he will not qualify to be accredited. So what is the qualification? A gross income of $200,000 a year, that is 1.8 crores in India, in rupees, or net assets of $1 million, which is about 8.8 crores, of which at least $500,000 are financial assets. So if you qualify for these, you can take an accredited investor certification from SEBI. But what does this get you? This enables you to bypass the minimum investment or the minimum fee norms from AIFs or PMS providers. So normally if an AIF would say the minimum investment is $150,000 for Gift City or a 1 crore for an Indian investment, Indian AIF, you could very well negotiate with that AIF and come in with a lower sum of investment. Okay. So this opens up the gate for making less commitments, taking a less risk in some sense, and still getting benefit of these instruments for global diversification. So if you do this, I do recommend that you go ahead and get yourself certified as an AI, accredited investor, okay, and do this. Okay. So the other thing that has rattled global market connected to tariffs is the US tariffs on Switzerland, which were 39%. Okay. Strangely, the customs wing of the US government has extended these tariffs to import of gold by the US. So gold bars of 1 kilo and 100 grams, so I'm not sure. So these gold bars will also be slapped with a duty of 39%. That makes gold in US far more expensive than the rest of the world. Very, very strange. I don't think the markets have a clue as how to deal with this, because as we speak, gold in London and Hong Kong trades at a significant discount to gold in the US. Let's see how the markets take this. But yes, tariffs are creating chaos. Not only things like gold, US manufacturing has actually fallen. The manufacturing PMI is falling. Automobile industries are one of the mainstay of the US economy, manufacturing economy, are not able to deal with this because the metals that they import have a tariff. So actually this could turn right around on the US president and hurt the economy more than what he's imagining. Okay. So let's be cautious. Let's be diversified in our portfolios. If it is an Indian portfolio, ensure sector wise you're well diversified, and with a global view, ensure that you do have investments outside of India too. And this is how we tackle risk, folks. Have a good weekend. That's all for today.